morning, everyone. Welcome to our new series, Power Talk, Mining Money with Money Managers. As we all know that asset management is a business governed by 1,000 distinct philosophies. It can be a hard science, abstract art, or anything in between. Investment philosophy and approach to equity market are the core of a fund manager's work and can often meet the difference between the success and failure of a scheme or fund manager. Do they view the process of investing as a science, a series of mathematical equations that they are obeying, or do they see themselves as artists listening to their gut feeling or recognizing any kind of a pattern that their peer or competitors don't see? So today we have Mr. Krishna Sangvi, CIO, Mahindra Manulife Asset Management Company, and Mr. Manish Luna, Fund Manager Equity. So just to give the audience a brief about both the fund managers and the CIO, Mr. Sangvi joined the fund house in, I believe, in 2009 November, bringing more than 25 years of experience, out of which he spent 15 years in equity research and the fund management side. His performance in earlier stint in Kotak Mutual Fund and the Canada Robeco was extremely known and good. Uh, at the same time, Mr. Lodha has the overall 20 years plus kind of a experience, of which around 11 years have been in the mutual fund industry. He has been in a various role and designation in mutual fund industry and the insurance industry. So we have both the expertise here to understand of how they are managing the money, what their philosophy or Mahindra philosophy is, uh, their process, and how this actually impacts on the performance. Ultimately, the philosophy is the inputs which we put in, and the output is definitely we can see in terms of performance. So, without taking much time, I'm just handing over to Mr. Sanghi. So you can take us to your idea generation process which you follow.
Sure. Yeah. Thanks, Ritu. And again, maybe good afternoon, good evening, everyone. In terms of, broad thoughts, I agree with, what Ritu said about the relevance of, investment philosophy, investment framework to the entire decision-making process. But, I'll possibly start with a caveat. All philosophies are good, all relevant, but they have an attached condition of, evaluation time frame. So if you follow a particular philosophy, the objective or what's the measurable against them, it's very important, because if you're really going in, for example, I'm using a very sports analogy. Pardon me if it sounds very basic, but yeah, if you're going to play a cricket match, you can't go with a hockey stick. You go to hockey play, go take a hockey stick. You go to cricket match, take a cricket bat. So I think that's what brought the philosophy. Obviously ends up with some comparison with how the measurables are, what the evaluation process is, and to an extent that's what takes the time for a fund manager, an individual capacity, for a fund house, for an investor, even for a wealth manager like Nirmal Bank, because there is a philosophy. Philosophy may or may not always give you outcome in the time frame which you desire. These are markets beyond a point. Let's accept we've seen the cycles that markets do behave in a different way. A lot of times one knows what's happening in market is perhaps irrational, but that irrationality to turn to rationality need not happen in the time frame which we desire. And that's where the core thought process of how does one evaluate a company, possibly how does one look at the holding period for a stock, and what's the evaluation time frame or a re-evaluation time frame, because at times the market does force us to change our core thoughts. There was a core thought, for all of us, the core thought which was perhaps I'll say on 15th April 2020. I'm saying exactly 1 month after the COVID broke out, and a lot of those basic issues were addressed. The reactions on market were very different between that day to maybe I'll say December 2020 versus December 21, and where we are in September 22. I guess at various points of time, we've learned again the hard way or the easy way, saying that market has a unique advantage. Market is nothing but a combination of multiple people like us, and somewhere the same data point is seen very different perspective, different multiples are attached to the same data point at different points of time, and that's what makes our life very interesting. Try to have a framework, try to have a philosophy at the same time, have that basic discipline which is required to do that. So I have a small presentation, maybe I can use it as a backdrop. I'll just start sharing it, and maybe we can take it forward in terms of how best we can engage into this, get some output which perhaps meets. So Ritu, is this visible?
It's visible.
Yeah. So a little bit about us. We are basically Mahindra Manulife in a way mutual fund as a trust entity. Mahindra Manulife Investment Management is a legal entity, a joint venture between Mahindra Finance, which is 51% ownership, and Manulife, which is 49% ownership. We are in a way owned by Manulife Singapore, which eventually is owned by Manulife Corporation Canada. So that's the basically structure. We part of Asia team for Manulife, and obviously subsidiary structure in terms of 51% is owned by Mahindra Finance. Both organized bring their own special talent and special business expertise. Mahindra Finance has a basic understanding of Indian consumers, Indian economy. Manulife brings in on table its own investment management framework and risk management, learnings over life of their, they're basically 135-year-old plus organization in terms of existence, and to an extent, possibly adds a lot of value to how environments have changed in the world, how global economies have evolved, and how transitions happen. That's broadly it. This is a little bit about the investment philosophy framework, and I can say this is the core philosophy which dominates every fund of ours. There will be some marginal change, marginal variations being added based on the nature of the fund. But essentially, if I have to use a word called GCMV, is what we practice as a fund house. This is incidentally taken from Manulife Corporation Asia team, where the idea is that being in Asia, which is the growth capital of the world, the need to look at companies is slightly different, perhaps. So you look at every company in on this, trying to segregate into these four parts of growth, cash flow, management, and valuation. That's GCMV. So look at growth. Look at any industry today. When you try to figure out where will the growth come for, so you can say, can it come from pricing power? Can it come from cost efficiency? Can it come from new product launches? Is there any risk coming from to growth from a ESG kind of opportunities? These are the 4 points I highlighted, but I can always add more, saying, can this company add more, sell more products next year? Very simple. I mean, it's nothing else, to say that, okay, if this company has sold 110,000 units this year, can it sell 120,000, 130,000 next year? If they sell, is there a market? If they sell, is there a pricing power they have in place? Or can they do something better by way of their cost efficiency to make more money? Are they able to migrate to a new product cycle? So for example, companies look at Indian market, Indian demography. We have varied socio-economic profile, varied age group. So can this company move from a current product group to a different product group, where it can actually get more customer segments for themselves? Second variable is cash flow. The basic belief is that a business makes money only if there is a cash generated. Otherwise, at some stage, end up into a debt trap or a working capital mismatch, which ends up typically losing money rather than gaining money. So a good look at cost structure of a company. What is the margin profile, the current capital structure, what's the ability to finance growth? One typically loves a company which actually generates enough cash for itself to grow in future. Ideal world, if you leave aside banking, because banking as a business where capital is perhaps being used for deploying, and there is this regulatory rules around how much leverage you can do. But any other business, we typically love, okay, yeah, as long as this company is not likely to raise capital in next 2, 3, 4 years, and ability to grow nicely, you are basically saying that existing shareholders will benefit far more from the growth profile of the company. In a banking case, evaluations are slightly different because for a bank to grow and lend more, it needs more capital. Capital always may not come from same set of shareholders. So to an extent, I said capital structure in a cash flow generation, banks are typically excluded in the analysis. And last is, overall financial strength. Is there a cash flow generation to move your debt into debt repaid and company becoming net cash kind of status? Again, some of these variables we've learned over time, they start influencing how the valuations look at. You look at typically a company which has a good amount of debt versus zero debt, the market valuations do matter. Valuations change in your favor when the same company undergoes a zero debt or a net cash position. Third variable is management. There's a track record of every management available. Luckily, even if you don't know much, just do a Google search and you figure out where this set of management team was present in past, what sort of role they played in the growth of those companies, whether it's promoter, whether it's a professional management, track record perhaps matters. What is the historical way this company has allocated capital? Have they gone into some sort of a wrong businesses or failed business outcomes? What is the sustainability investments? This is an outcome of this ESG, sustainability and governance, because nowadays a lot of focus goes on, yes, you are doing right from the profitability angle, but is this profit sustainable? Is the governance structure good? We realize that longevity through the sustainability route, some sort of governance comfort has given far more higher valuation to businesses, and that's where wealth creation has happened in past. All of us have gone through this cycle over the last 20 years. We've seen enough ups and downs where any company with a questionable governance has actually ended up, being lost in terms of equity market acceptance levels. Last part is in a way the toughest part. What's the valuation? What's the value creation potential, and what's the fair value? Honestly, there are no fair value in markets. We've learned right in front of us. We would have seen a stock move from 100 to 150 back to 100 in less than 12 months. And that's the beauty of markets. We have to understand valuation in the context of some of the evolving principle, which is says what has been priced in. There are times we decide this is good, money has been made in the stock, enough is money is made, there's not much of upside. Sometimes we decide, okay, well, we made some money, but there's a lot of more money left. And that's where a continuous evaluation of this item called growth, cash flow, and management comes into play. Well, we would have bought initially the company, we made our money, but if we believe the growth is on track, incremental management action is still favorable, we to hold on. So if you look at this variable, all those four variables, we say, okay, there is a fair value analysis done by our own team. And then we say, okay, what's the current price? Is there a valuation gap? On an average, I think for 95% of companies, you'll find a valuation gap because markets are never efficient. You'll always have your assumptions being different from, what current stock price implies. And then you try to search, is there a catalyst to make it happen in our time frame? I guess the way markets are, very honestly, everybody likes to invest for long term. We also like long term, but I think every long term has a milestone. To my mind, the milestones is 12 to 18 months time frame, wherein what you think today is likely to evolve should be set in some context of getting it measured in a time frame of, let's say, next 12 to 18 months. We are happy to continue the journey as long as we get the desired output in this small time frame of 12-18 months period. Moment that time frame is achieved, we obviously have to revise our assumption on fair value, our assumption of this catalyst. But net, that's where catalyst and the time frame does it. So if it matches our time frame, matches our catalyst time frame, we basically say there's money to be made on re-rating. Again, all of us on we've learned from market, more money has been typically made in the re-rating vis-a-vis earning growth, because that's what is the valuation angle, is what the management quality angle which survives over time. Looking at market as a glance, this is where maybe I'll add something more about our investment process internally, what we do. But net, that's the current market cap range: large, mid, small, top 100 companies, next 150, and the remaining 251 onwards. That's how it goes. On an average, you say there's a startup phase, growth phase, mature phase. This is generic term. Not every small cap will qualify, and not every large cap will qualify. But that's a broad phase where the growth rate of some of these companies start becoming mature phase. The idea really here is that when you look at markets and economy combination, actually, let me put it economic combination. There's a lot of this internal connect between a large cap, mid cap, and small cap. I'll use a very small example of auto industry. Almost every auto company, which is where we see buy a product, whether it's a car or a two wheeler or a commercial vehicle, etc. They are all large cap companies. But almost every company has its own ancillary system, which is either a mid cap or a small cap. Every car or basically every automobile needs a tire, and majority tire companies are going to be in mid cap or a small cap. Every auto company needs enough auto components, whether it's the steering system, whether it's the wiring harness, whether it's a brake system, clutch system, suspension, etc. So there is an interlink between a large cap, mid cap, and small cap. Every company requires somebody else in the value chain, as either as a vendor or as a customer, to survive. And this is typically true across industries. Auto is an easy example, but it plays out even in consumer sector. It even plays out in industrial manufacturing. It plays out, I guess, across the space. So that's the thing. The second part of market also is every dependency. One core thought in market really is one man's expense is other man's income. So when a company spends on advertisement, media company gets revenues. That's how the economic cycle shifts from company A to company B and sector A to sector B, and that's a model which all of us try to see. So let's say collectively as a team, keeping our own GCME framework intact in terms of identifying the company. The next step is at what point of time in the cycle one tries to buy it, at what price in terms of valuation multiple one decides to buy. I think that's where those macro overlays of top down start playing out. If one believes that the environment is more conducive to consumer sector versus capital goods sector versus the banking sector, some of those actions move from that angle as a top down. The choice of company is clearly bottom up because that's where we make money. But again, the re-rating, de-rating combination is partly a function of sectoral flavor. A sector doing well typically ends up making far more money rather than sector not doing well from an economic cycle. Let's not forget there's an economic cycle which is underlying everything. Unless a company makes profits, you're not going to get into wealth creation. Yeah, last 3 years of experience has taught us something new, which is perhaps saying that even a loss-making company can list on market, can have its own market cap. But I think that's a aberration of a very limited scale. They're not wrong companies. It's just that the time frame of investor does vary. Instead of looking at the same company with a 2-year time frame or so, as I said, 12 to 18-month time frame maybe, versus somebody looking at a 10-year, perhaps there might be value in those companies also. But the challenge in all this is ability to stand through that 3, 5, 10-year journey when one wants to buy something with a profit 10-year down the line. Then you obviously have to figure out that my waiting period should be perhaps as good as what possibly I am investing at the point of decision making the point of investing. So that's a little bit on markets. Yeah, a little bit about our team basically. So we have a team of 4 research analysts broadly classified into various sectors, various industrial themes, let's say. So one Indian theme is consumers, which basically includes auto, retail, consumer staples, consumer discretionary, etc., media. Other sector is BFSI, banking, financial service, insurance, capital market, etc. Third is entire global trade opportunity, which is IT, pharma, chemicals, etc. And the fourth is industrial and infrastructure. So that's a 4-member research team, each perhaps covering something between 40 to 60 stocks. We also have totally 4 fund managers, including myself and Manish as 2 of us. Between 4 of us, we do cover another 40, 60 stocks across industries which are not covered by analysts. Essentially commodities, whether it's cement, steel, aluminum, maybe oil, perhaps these are the things we look at, and some unique stocks like paper, for example, textile, for example. That makes around, I'll say, 220 to 250 stock universe broadly between the funds which we manage. Every analyst comes up with their core ideas to present what they like. Fund managers end up evaluating those on a relative basis and then end up creating portfolio respecting those the mandates which we create. for the fund, because mandates partly are coming from the offer document itself of large cap, mid cap, small cap, minimum or maximum requirements. Coming to, I say, a little bit thoughts on markets the way we see right now. I think this is the one big picture all of us should remember. In 2006 calendar, India was 14th rank economy in the world. In CY21, we were 7th. Uh, this is the GDP, market cap, Nifty index values, and by default, the multipliers, which we are seeing here, is very interesting in the sense that we've actually uh, gone in terms of 5x on GDP terms, 7x on market cap, and Nifty is 4.4. If you look from a FII perspective, I'm converting everything into dollars and USD, and that's where numbers are lower, but still they are pretty high. 3.3 times GDP, market cap is 4.3, and Nifty is 2.6. So that's the big picture. We have grown as an economy from 14th rank to 7th rank. I understand this is CY21, December 21. Last month, some data point came which said that you become 5th. That's because they've taken the current currency exchange rates for British pound, etc. But this data is as of December rather than 2 days conversion of their data points. We've seen how the world currency markets have gone into a different direction in last 6 months. So that would have changed. But macro is simple. We moved from 14 to 7. We likely to move to number 3 as per a lot of analyst estimates, including World Bank, IMF, etc. I think it should happen this decade. 27, 28, 29 is anybody's guess. In a way, theoretically, we jumped to number 5 just in last 9 months, because December we were 7th. In August we become 7 to 5th because of currency differential having played out vis-a-vis some other economy. But I think that's a macro message. How much money has been created in terms of GDP growth, in terms of market cap, in terms of even index. Broad assumption we should make that markets are for wealth creation. As we move from this 7th to 3rd, reasonable bullishness one should have as an investor in this process of wealth creation is one. I think this is the second big picture. What has changed 2016 onwards? 2016 it was demonetization event. 2017 was GST. Again, 2017 was insolvency bill, and maybe 2020 and onwards has been COVID policy reaction, monetary and fiscal. We've seen impact is very much on increased formalization and digitalization world. Balance sheets are deleveraged. Capex cycle has started, courtesy the PLI. Insolvency bill has really changed the asset quality perspective for India. If I have to really say, one of the maybe top 3 reforms, I'll say, was when NCLT process allowed change of ownership of some of those laws, those defaulting companies. For the first time, maybe some corporates were forced to get out of their ownership of companies, and that has made a lot of change to asset quality profile for banks. NPS are decadal lows, and which is honestly very good sign for incremental credit growth and cycle. And there is increase in confidence to invest. Outcome is pretty simple, I guess. GDP growth. There's a rising corporate profit to GDP trend, and there is a growth across sectors and across market caps. Is a basic belief which we have seen and we are likely to see. That's the last thing on this broad picture. There's a growth cycle in place. As India goes for formalization and digitization, what happens is government of India gets more money. We have a rising tax collection to GDP ratio, which is helping government create a better infra and helping them PLI. So by PLI, what they are telling corporate sector is that if you decide to produce some things which are meant for exports or meant for import replacement, we will give you some subsidy. All of us are enthused at seeing this news article almost every second day about which is the latest product being made in India. I mean, iPhone 14 is perhaps one of the latest product to be made in India. Some of these things are part of PLI. Some of these things are, honestly, India as a ease of manufacturing or ease of doing business destination. When corporates make more money, either by PLI incentives or either by making profits, they reinvest. When they reinvest, better jobs are created. So it is a nice circular loop where government makes more money, government invests in infrastructure, government incentivizes industry creates more jobs, and more jobs means more consumption again means more tax collection to government. It's a nice sweet spot, honestly, to be in, and I think we entered this. Uh, this is going to be a driving force for economy for some more time. Key thoughts on markets. Some of this maybe you might be reading on a daily basis, but I think just nice. I'll not spend too much time. The worry over inflation remains. Inflation issue is somewhere moved to geopolitical angle because of energy price. There is clearly a valuation concern because of Fed's plan of liquidity. Let's not forget that it was Fed's action which brought money to the market and brought valuation increase to the markets. So if they're withdrawing money, there might be some challenges in the near term. There's a recession fear in developed markets, and it's a very nice. I say I think maybe oxymoron is a word in market which says the bad news is good news. Kind of question mark. I really don't know when will we reach that stage. But there were times historically in last 5 years where every bad data point of economy was seen by markets is a good, that so that Fed will not create more problem for economy. Will not do any tightening. US stands some issues. I think on the India side, RBI is acting pretty much in sync with global central bankers. Will have a policy coming up this Friday. We'll know more about what exactly is a new change. Yeah, I think fiscal stability in place. Current account, there are some pressures. Hopefully, we'll be coming out of it soon. Crude price and Nifty both, have broadly gone through and they've basically come to new levels vis-a-vis what they were pre-conflict. So macro story is good growth, digital world. Micro story is good banking system, corporate earning growth. Come to pure market thoughts. We should be always happy to have this global market connect. Man, almost all of us end up checking Dow Jones first thing in the morning, what happened yesterday. So that's a global connect. Before we come to office, we know what's happening to Singapore Nifty. That's sentiment, and then the liquidity connect. End of the day, liquidity is what was the FII flows today evening. That's our daily connect, and that will remain. That's the beauty of markets. They're supposed to remain. I think our broad valuations are in line with our long-term average. We should not really worry too much. The only challenge is, what does Fed do? Can that alter the long-term valuation? Can be the challenge. Otherwise, broadly, it's okay. PLI is a good opportunity. Import substitution, exports combination. We also believe RBI policy influences market cap cycle between mid, large, and small. Linkage is there where if RBI goes for raising mode, we typically see mid and small do very well. When RBI goes for some tightening, we see mid and small having some sort of implications. Some of these are dynamic in the sense that they get more impacted when there is a corporate leverage. When corporate leverage is not there, perhaps implications are not as severe. It's a favorite chart. All of us knows this, how Sensex has behaved in last maybe 40 to 43 years. Nobody can forget some of those, terrible times which we would have gone through. 50-60% fall happening in 6 months. 50% fall we would have seen 2-3 times. So don't worry. I think the big picture remains that there are returns with volatility, and volatility get adjusted with time, which is what comes back to investment philosophy all over again. If you've chosen the right set of companies, right set of stocks, markets will end up being volatile in terms of stock price, but you will typically end up generating returns. This is SML, small, mid, and large. Big message is, as the Hindi word goes, sabka time aayega. Winners of any given year ends up becoming some sort of a loser in the year after, and the leadership changes. If somebody really decides to implement this on a consistent basis, very high probability of able to time the market cap cycle. As you see, the green bars are Nifty small cap. On an average, whichever year that was the highest has ended up becoming the loser next year. And the blue is Nifty, and the maroon one is perhaps Nifty mid cap. I can say maybe the safest bet perhaps can be mid cap. Always been on an average in the midpoint. Between small and large, the leadership keeps on changing. So that's the angle. I think this is a little bit about our team. 4 of us, I said 4 fund managers. Myself, Manish, Fatima Pacha, and Abhinav Khandelwal. That's a 4-member team. I think that's broadly from my end. Ritu, happy to hand it over back to you.
Yes. Thank you, sir. Thank you for giving us a brief about how Mahindra follow what is the Mahindra's philosophy basically for the stock selection and all. I have basically only two questions on this philosophy part. One is what will you do to minimize the risk associated with investing any kind of a corpus? And second is a no model, whatever model you are using. I believe, personally believe that no model can, tell you how much exposure you should take in a particular sector or particular stock. How do you arrive, at that exposure?
I agree. So that's the advantage, as you know, as the saying goes, there is a natural, human intelligence which overrides artificial intelligence. So you're right. Model tells us what stocks look good, what can be the incremental upside. The human, intervention or our own, uh, I'll say, analytical thought process tells us how much money to put at what sort of cycle, of the stock valuation we are, what is the sector dynamics. It tells us whether to put 5, 7, 10% of money or to put 2, 3, 4% of money. That's subjective, and that's where risk management comes in. So one easy answer I can give you is that if it's a mid cap company, we typically say a 3.5% exposure is pretty good per stock, so that it does help in some risk containment, some risk management. If it's a small cap company, on an average, I'll say 2.5% at the point of investment. We're happy to let it run more than that, in the sense that if you invest 2.5%, if it becomes 3% because of mark to market gain, there is no immediate rush to come back to 2.5. But at the point of investment, what one thinks is that finally we are running a diversified portfolio. We are not running a concentrated portfolio. It's honestly not a scheme where we would like to end up being exposed to a single company issues. And market against have taught us in last 20-30 years, a lot of bad things happen to good companies because of environment beyond their control. There are businesses which get impacted by some regulatory policy change. Some duties get imposed either in India or internationally, and the entire earning profile can go through a risk. There are issues where something suddenly can crop up in a corporate governance on an incremental basis. While everything was good when we invested, something can always change. So I think the risk management teaches us that better to put in effort to look at 5 more ideas rather than putting all your eggs into one basket and go with a big number. So that's the second part. Coming to sector level, yes, I think sector level there's a reasonably large limits on overweight underweight, where the idea is simple. There are sectors where the support system is in place in terms of tailwinds from macroeconomy. There are times there are tailwinds coming from policy news flow perspective. Like look at capital goods, for example. In a lot of capital goods companies, the business gets driven over next 2 or 3 years of delivery, but the order book accretion happens today. So sometimes, the idea is to look at these companies from order book accretion, news flow, rather than immediately on earning, because earning is going to come 12 or 18 months down the line after the order book is created. So that will be, a unique sector-wise, cases, behavior. Again, respect for valuation is maybe the third angle, I'll say, in analyzing and arriving at those big decisions on how much overweight one should carry. Because if valuations are reasonably ahead of time or vis-a-vis the historical averages, one would like to take a breather saying, let me make money, but let me not expose myself too much at a euphoric times in market. Because, higher the valuation, you tend to say this is more of euphoric behavior. I think that's, broadly how one tries to segregate in our own mind about is it a right time to invest and how much to invest perhaps goes through. I'm sorry, Ritu, I missed the first question. If you help me with it again.
So I have simply asked the risk associated, how you minimize the risk associated with the investment. So is there any kind of a risk management strategy, like you said, the stock cutoff or the sector overweight, underweight kind of a cap?
Yeah, so I guess I just mentioned about mid cap, small cap, that 2.5 and 3.5% limits for small cap and mid cap respectively. I think from a sector perspective, honestly, there are just 2 sectors which actually end up at more than 15% of market in terms of benchmark, which is IT and banking in a way. Almost all other sectors are basically beyond 15. Their broad idea is to maintain a 5%, 7% kind of overweight on those sectors which are below 15% weight. And otherwise, for sectors higher, we typically end up going slightly more, maybe 7 to 10. But that's a broad range. I don't see we removing those in a exceptional case. We'll not. I don't see we removing that. We'll stick to those numbers. Is what the broad idea is on the risk management front. If one is very bullish, one would prefer to take a stock specific call and go more aggressive on stock selection front rather than going too much on a sector calls.
Okay, so just connecting to this point, there are a lot many ongoing themes in the market, like business cycle, China plus, manufacturing perspective, ESG sort of, a lot many themes we keep learning about that. Do you believe any of this theme or any specific theme you believe or you implement in your funds?
Sorry, I missed the last comment. You believe?
So do you believe any of these kind of themes actually can work out in this market, or any kind of this theme you implement in your funds?
So I think, see, honestly, we have let's say a thematic scheme called consumption. We have a rural Bharat and consumption fund, which essentially says that, I mean, the broad thesis is that India is a country of approximately 140 crore people, and is a huge consumer market. Broadly, any and every product can be sold to this mass, of 140 crore people, based on socio-economic profile, based on earning, diversity across this group. So that's a product which we have. Coming to other products, yeah, I think all of these products finally have a space for an investor. It's just a question of how much money you want to bet on a theme versus how much you want to bet on a diversified product. How much you believe you will be able to, get an exit at the right time. If you invest in a diversified scheme, there's a fair probability that fund managers are gonna do the needful of moving out of excessively valued sectors into something else. When you enter a particular theme, there are fair chances that even if the theme gets into euphoric valuation, the mandate of the portfolio might force the fund to remain invested there. So that's going to be, I think, investors' choice on when to move out of the scheme rather than the portfolio managers.
Okay. Krishna, we have seen Mahindra has seen a super growth in last 1.5, 2 years, a time frame. And I'm sure the funds also actually perform very well and they also added a value. What are the three things that you contributed to this growth?
No, I think first answer perhaps can be respect for valuation, because in this entire journey of last period which you're mentioning, we've seen enough ups and downs of sectoral movements. Some of the best performing stock in first 6 months ended up becoming the worst performing in next 6 months, and that's where connect to valuations do matter. Second part really was a little bit ahead of times in terms of deciding or looking that we are in a fiscal growth mode. We had a tough time of COVID, where economy virtually stopped, and it was slightly a tough call to actually make that. When do we get into economic policy normalization mode? Because while government was putting efforts, economy was not normal. People were still sitting at home. Not all activities were happening on time. So that's the second angle. And third angle is maybe slightly early on the curve on getting this PLI scheme perspective. Because moment government introduced PLI schemes, one possibly could have got an inclination that any sector which government wants to push actively to gain market share in the world, and government itself is willing to finance or give an incentive to the corporates. I think corporate India will rise to the occasion by saying, okay, let me take this PLI scheme and let me apply for a eligibility criteria, and if I get it, I do capex. So moment one accepted PLI as an early outcome, the immediate next was actually the capex cycle, because for the underlying part of PLI was really that the incentive is linked to production, and production by definition was going to come from a new factory, especially when you add that 2019 September income tax reduction criteria, which said a new factory will actually get a lower tax rate even from income tax purpose. It was a very sweet spot for corporate capex to pick up. They had everything best in the world. Global corporates were looking for some diversification away from China. Global countries were basically forcing their companies to do something about getting a diversification. Here was Indian government financing or giving incentives to corporates. So it was a sweet spot for everyone, and that's where I think capex cycle also would have played a nice role in some of those outperformances which we're talking about.
Okay. Krishna, you said the second point is ahead of time. Probably you must have taken a few bets where those bets actually been fruitful to the portfolio or added to the portfolio returns. In the current market, if you can explain us like any kind of ideas which you have taken a bet and you believe that is ahead of the time kind of idea, probably.
No, so I think if you look at market, especially in the current context, maybe I'm just using last 1 or 2 months as an example, and look at estimating or looking at next 12 to 18-month time frame. I think one interesting angle coming up in the market really is a consumption as a sector, consumers as a space broadly. Here is a space where if you look from a fundamental perspective, the belief is that as we move ahead in next 12 to 18 months, there'll be a lot of consumer spend coming either because of policymaker. We are going to get into some election cycle in next 12 to 18 months. Quite a few elections in India. That's a time a lot of money gets spent. Second, we are also in a situation where all the expected implementation of the PLI schemes will happen. So one of those end game of PLI is going to be job creation and employment of India's factors of production like land and labor. Indian logistics companies can have a good role to play. Indian landowners can have a good role to play. Indian employees will get some more salary. So I think that's the income creation for them. What some of these corporates will earn by way of exporting or getting government incentive will finally be used in this particular way. So that's the second part, some income increase for this. And third is actually valuation. From where some of these companies were trading 2 years back and where they are today, we've seen a lot of these companies having a reasonably similar price point, despite those companies having grown in terms of absolute revenue growth, absolute profit growth. So when you combine the three, I guess we in a spot where looking at a 12-18 month time frame, there is a nice spot available where consumers can have a role. Obviously, this does not mean we're not present in existing relevant themes. So, for example, today one of the good themes obviously is banking, which I mentioned in one of the slides, where we have a reasonably good asset quality cycle playing out. Companies are going to have a lesser credit cost as a percentage vis-a-vis the historical trends. We are in credit growth uptick, perhaps one of the best credit growth in last 5-7 years we are witnessing now. So it's a good spot for banking also. So that's I think some combination of this. But yeah, if some theme really looking for 12-18 months, I think consumers is one spot I would like to mention.
Okay, so before moving to our next round, which is a rapid fire, as I explained you, so I would just request participants, if you have any kind of a questions, you can post it on a chat. So probably we'll take it ahead. So Manish, you can also participate in this and you can answer. So my first question is, what would you advise first? Investment performance?
Sorry, your question was not clearly audible. Can you repeat it?
Yes. My question is, what would you sacrifice first, investment performance or investment principle?
Investment performance.
Okay. Krishna sir?
Sorry, I'm asking the same question. What is the investment performance versus?
Investment principles.
Principles matter.
The philosophy, basically.
Yeah, philosophy matters.
Okay. So if you could change your allocation in your fund or any kind of a sectors, what would you buy and sell at this point in time?
Honestly, we're doing every day. So I will refrain. It's honestly a sensitive question from a compliance angle.
Okay. So, what would you do differently if you could start the year afresh? So, any kind of a sector, any kind of a theme you would like to pick?
Start as in if I'm in January 2022.
Yes.
Oh, lovely. I would have been out of IT because I know the hindsight what happened.
Okay. So the next question is, when could your strategy underperform in different market conditions? Because the investment philosophy, I don't think so. The investment philosophy, works across market cycles.
Yeah. I think so there are broadly, there are two approaches. One is to say that let's focus on next 12, 18 months earnings. Unfortunately, in that route, there is far more focus on what the company is doing right now. There's other approach in market which says let's do a growth investing where I don't worry about next 12, 18 months. I better worry about 3 and 5, 7 years. So in that model, I think when cost of money is too cheap, people do end up getting, influenced by looking at 5 and 7 and 10 year pictures. When money is reasonably available, people have to focus on what's happening in next 12, 18 months. I think that's one philosophy which can be impacted because if you are in an economy which is focused on earnings, then you will obviously struggle when the market is focusing only on far distance future dreams.
Okay. So name
because honestly, if here is a company which is making loss today and likely to make loss for next 3 years, it is very tough for me to actually buy a company saying that I am willing to hold it for 4 full years and seeing a loss every year for next 4 years. Because then my holding period ideally should coincide with the turnaround in the company rather than holding for all the 4 years despite seeing a spate of losses not seeing, but actually anticipating a loss in our own model, even on company's own guidance for next 3-4 years, then it's slightly tougher to buy those companies.
Any kind of changes you have made in your investment process recently, and has it brought in any kind of an improvement?
Manish, if you want to.
No, I think we haven't done any significant change in the investment process. So the process is, as Krishna illustrated, that post Manulife JV coming in, this is the ratio team process. And though we have taken some risk management, further risk management initiatives in terms of the single stock weight in the mid cap, small caps, and maybe the sector caps, which we are following for last 6 to 8 quarters.
Okay. So my next question to both of you: a mistake you made in recent past, and what have you learned from it? So I'm sure that will be probably different from both of you, the experience. So Manish, first you can answer.
So yeah, so it's an ongoing process, and every call you take is not successful, or mistakes are part and parcel of the life. So if you can't do any mistake, then you are not doing a job properly. That's the belief. But the bigger thing is that whether we are learning from the mistakes or not. So that's something which is an ongoing process, and strengthen our beliefs and our experience and skills.
Well, I think market teaches us a lot on a daily basis. If you just focus on where we were, let's say in mid-Feb pre-war versus where we are today, broadly market levels are identical, but the kind of volatility we've gone through is very different. Even if you look at the June lows, which markets were at something like 15,200 odd on Nifty or so. It's very interesting, but I like to highlight to everyone that US 10-year, which was seen as a primary reason for market fall, that time was perhaps less than 3.3 on US 10-year, while market went to 15,200. Today, US 10-year as of yesterday maybe was 3.95 or maybe 4, but markets are actually roughly 2,000 points higher than where they were. So that's the beauty of markets. It teaches us that a lot of rules have to be flexible. the stock selection criteria has to be far more, let's say rigid, far more process driven. The implementation in terms of weight for the stock, which is in a way combination of valuation as well as the market dynamics of behavioral finance matters. So without compromising on the process for stock selection, one does end up taking those calls on how to go for a higher or a lower weight for the same set of earnings, which in a way tries to capture the valuation modes.
Okay, so now skin in the game is very much there in the industry. So which fund do you pick? Whether it's a focused multi-cap or the large and mid-cap?
So I think the skin in the game luckily is very well defined for me. Every scheme gets allocation based on what the rules are. So I'll put it this way: focus is actually for a concentrated exposure. People who love only 30 stocks kind of exposure. By default, it may bring its own volatility. It may bring its own good returns and maybe inferior returns at times, depending on those 30 stocks playing out. But if somebody prefers a slightly more concentrated approach, I think focus is there. Otherwise, I'll say, multi-cap. Multi-cap gives you a nice flavor between large cap, mid-cap, small cap. Allows the fund manager a nice flexibility to go a little bit more overweight than what those minimum numbers are. At the same time, doesn't really make him or her do extreme behavior of turning zero because of the minimum mandates. I think those two will be my first two names.
Okay, thanks for answering all the questions. And I'll just pick up quickly the few questions I have received on the chat. So first question is, how do you take this current market correction where we should invest?
So again, I think where we should invest, I think my first answer is equity, because that's where we are. If you really have a next 12-month view, I'll suggest prefer a large cap. But honestly, if moment you say I am an investor for that typical 3-year and above time frame, which is what we all should ideally look for, I'll say take a multi-cap as a fund. It gives you a nice exposure to large cap, mid cap, small cap. Fund manager has reasonable freedom to get into stock selection because of the sheer range available to him. I think that should be one, and maybe the second name which I also mentioned, focus.
And what about your view on the current market correction?
Current market conditions obviously are quite fluid in terms of the environment around us. So there are basically three issues. One issue is what US Fed is doing and how it is impacting the world. In terms of, there was a time money was available reasonably free. Now that money is being made slightly expensive or it's being curtailed. So some reaction will happen. People with leveraged positions will be forced to get out. It doesn't matter to investors. Second, what is happening around is geopolitics, which is hurting some of our macroeconomic fundamentals through oil route. Nothing else, honestly, but oil is clearly something which is hurting us. Trust me, no answers apart from the hope that India can keep on increasing its purchases from Russia, which is coming at 20-30% cheaper, and by default we are still at the same price at what India was paying a year back. Third part of this answer is luckily Indian dynamics are very good. Our RBI policy is pretty much on line, mapping what's happening in the world across central banks. So that's a good sign. Coming to Indian fiscal side, again, pretty healthy. I mean, we've learned actually in last 24 months that the kind of support system India did in terms of fiscal consolidation, fiscal, I'll say prudence, was far better than what a lot of countries in the world did in terms of giving free money and generating in the entire big genie of inflation. Luckily, our fiscal situation is pretty sound as a country. While we speak, it's pretty good on every front. Tax collections are good, both GST and income tax. And the best part about this is that whatever money government is spending on an incremental basis is well directed using those, the digital route or the formal route where perhaps Aadhaar-based identification is helping remove the leakage, and the PLI-based spending is helping create jobs. So I think on a fiscal front, we are in a pretty good shape. Whenever in doubt, I say current market correction, ignore the word, go to the slide which I am showing right now on the screen, which says we were 14th rank in 2006. We are 7th rank in 2021. Would have faced this question of how do you face this current market correction at least 5 times in this entire period of last 16 years. And perhaps the end output is visible very clearly. As long as you are not leveraged as an investor, as long as you know it's a journey of wealth creation which allows for that time factor for your investment thoughts to play out, I think one should remain invested. One should perhaps use some of these opportunities to be invested more. Yes, there will be aberrations. For those aberrations, look at those other picture which I shared about this SML. Use it nicely to your advantage, where you say, okay, I'm an investor. I made a lot of money in a very short period of time. I mean, look at CY21 on this particular picture. Nifty 24%, small cap 59%. All of us know some of these returns are finally mean reversion because economic cycle are linked. All these companies are interlinked. So to an extent, use this. But yeah, stay invested. Use some of these principles of outperformance being captured through profit booking and getting into relative underperformance space for investing. I think the wealth creation journey is possibly pretty much on the cards for all of us.
So do you believe this is the right time to invest in equities? Definitely you said yes, but through a staggered manner is the best way to go with the equity funds?
See, honestly, staggered manner always helps because staggered manner just gives you that advantage of so-called timing over the period. If you really have staggered investment, you feel mentally safe because when markets, if at all they fall, you feel I have more money to invest. But use a staggered manner intelligently. So do not say that I want to invest over next. Suppose somebody decides I want to invest over 12 months. It's a good definition. But in between, if at all markets end up, giving a sharp dip, then do not wait for the same staggered manner to actually play out. Maybe you can prepone the investment that day. Like today, if market levels are looking high, and that's why you decide to stagger, there will be a journey in a point where market may fall, and that day market you should use to invest far more rather than deciding further to stagger. So I will say instead of systematic investment, you can start following smart investment. You fix your levels. Decide at what particular point of time you can call it valuation linked, you can call it absolute level of market linked. But if that level does come, then do not really wait. And then that's a time to actually say, let me, prepone the next 6 months, those investment checks or, this investment amount into today itself and make a far bigger investment today at a lower price point.
Okay, so I think the last question is the government talking about national logistic policy. Does mutual funds has any scheme driving this sector? So
honestly, we may not have a scheme, but I'm sure we'll have some stock somewhere in our schemes, which will try and benefit. And the best part, logistic policy does not really mean we have to own logistic stocks. We can also own companies which are spending far more money on logistic as a percentage of their business. And when the logistic policy actually gets implemented, those people who are spending money will actually benefit because the logistic policy will create efficiency, will create far more, improvement. So it can be anything. It can be a logistics service provider, can be a logistics service taker. Both are available as a good investment options. And yeah, as I said, well, we don't have a specific scheme, but we do have quite a few companies in some of our portfolios.
Okay. Fine, sir. Thank you so much. Thanks for giving insights on the markets and the philosophy side and the other factors also. And thank you, Manish sir, for coming. And we'll just wind up our call here. And thank you, participants, for joining in. Thank you so much.
Thanks, and thanks everyone at Nirmal Bank.
Thanks, Ritu. Thanks, everyone. Bye-bye.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.